Welcome. In this analysis, we're conducting a structured examination of Gaibo Pet, a prominent player in China's rapidly growing pet economy. We'll deconstruct its strategy, its performance, and its precise position within the market.
Our approach today will be to present the core conclusions up front. From there, we'll dive into the company's financial health, analyze the strategic drivers behind its growth, assess its competitive standing, and then conclude with an objective look at the market's debate on its future. All right, let's begin with the primary conclusions of our analysis. These are the core pillars that define Gaibo Pet's strength in the market today.
So 4 key pillars form the basis of the company's position. First, a sophisticated brand architecture. Second, a structural improvement in profitability. Third, superior operational and financial efficiency. And fourth, a deliberate focus on the domestic market. Let's keep these pillars in mind as we proceed.
Now, let's move to the financial performance. We're going to examine not just the growth itself, but the underlying quality of those numbers for the first half of 2025.
The top-line performance is without a doubt robust. Revenues reached 3.22 billion RMB, marking a nearly 33% year-over-year increase. It's a very strong signal of market momentum.
Net profit attributable to shareholders also grew, hitting 378 million RMB. Now you'll notice this growth rate is moderated compared to revenue. This is a direct result of strategic reinvestments back into the business, particularly in brand building.
But here's where the story gets really interesting. Look at the operating cash flow. It surged by 43%. This demonstrates incredibly strong cash generation from core operations, indicating that the reported profits are translating directly into liquid assets. This table provides the broader context. You can clearly see the structural improvement in the gross margin. At the same time, you'll note a slight dip in the net margin. This isn't a sign of weakness. It's the calculated outcome of a 47.3% surge in sales and marketing expenses, a strategic reinvestment to fuel future brand equity.
And this brings us to a crucial point about earnings quality. With a cash conversion ratio of nearly 93%, almost every dollar of reported profit is backed by actual cash. This financial self-sufficiency is what allows the company to fund its own capital expenditures and growth initiatives internally.
So, having established the financial outcomes, we'll now analyze the strategic engine that's driving these results.
At the core of their strategy is this elegant, two-pronged approach. MyFoodie acts as the cash cow, securing market share and providing stable revenue. On the other hand, Frega is the growth engine, capturing the high-value consumer and elevating the entire corporate image. It's a classic and effective portfolio strategy.
Now, this shift in the revenue mix is perhaps the single most important driver of profitability. Just observe how main food has transitioned from under half of the business to become the dominant category, all within a single year. This is a deliberate and fundamental change.
And here is precisely why that shift is so critical. It's the significant margin differential. The high-growth main food category carries a gross margin that is nearly 9 percentage points higher than the snacks business. This is the engine of their margin expansion.
So let's zoom out now to understand how Gaibo Pet is positioned within the broader competitive landscape.
The company is operating in a powerful secular growth trend. The total market is expanding at a compound annual rate of 16% and is projected to reach over 800 billion RMB by 2025. This provides a significant tailwind.
This chart demonstrates that the company is not just riding the industry wave, it's significantly outperforming its publicly listed domestic peers. While Gaibo grew over 32%, a key competitor, Pettico, actually contracted. This implies Gaibo is actively capturing market share.
And when benchmarked against its competitors, Gaibo exhibits superior growth and profitability. This superior performance is a key reason why it commands a higher valuation multiple in the market, with a P/E ratio of approximately 51.
And finally, we'll address the forward-looking perspective. We'll present the core arguments that define the market's debate around the company's valuation and future prospects. This really is the central question for any analyst covering the stock. Does the company's strong performance and its potential for future growth fully justify its current market premium? The bull case centers on the strength of the brand moat and the structural profit drivers. The bear case, however, focuses on escalating competition, the continued pressure from high marketing spend, and the valuation risk inherent in a stock that already prices in a great deal of future success. And beyond that market debate, These are the primary operational and external risks that warrant monitoring: intensifying competition, volatility in raw material prices, execution risk on major capital projects, and of course, any potential incidents related to food safety or brand reputation.
And that really is the crucial strategic question. Our analysis shows a company executing a very sound strategy within a high-growth market. However, its ability to defend its position and its margins against rising competitive pressure will be the ultimate determinant of its long-term success.